You know, we use money every single day. We earn it, we spend it, but have you ever really stopped to think about what it is? Or where it gets its power? Today, we're going to pull back the curtain on the fascinating story of money and its very close cousin, credit. We're going to explore the systems that, believe it or not, shape pretty much everything around us. So let's start at the very beginning, in a world that had no money at all.
All right, let's just imagine for a second a world with no cash, no coins, nothing. You're a shoemaker and you need some wheat to make bread. You find a farmer, but, well, she doesn't need shoes, she needs clothes. So, you're stuck. This is the big, messy problem at the heart of any barter system.
Economists have a pretty cool name for this exact situation: the double coincidence of wants. It's a fancy way of saying you have to find someone who not only has the thing you want, but who also wants the very specific thing you have. And you can see how this would be just super inefficient, right? It's the core reason we had to invent a better way.
So this whole mess, this inefficiency, is exactly why humanity needed a solution. And that solution turned out to be one of the most important inventions in all of human history: money.
See, money acts as this brilliant middleman. The shoemaker doesn't need to track down a farmer who's looking for shoes. Nope. He can just sell his shoes to anyone for money and then turn around and use that money to buy wheat from any farmer he wants. It completely shatters that problem of having to find the perfect trading partner.
Of course, money didn't always look the way it does now. For centuries, we used things that had their own built-in value. Think grain, cattle, or precious metals, like the gold in these ancient coins. Their value was right there in the object itself. But the currency we use today, it's really just paper and metal. Which brings us to the million-dollar question about our modern economy, doesn't it? If you can't eat it, you can't build with it, what on earth gives that piece of paper in your wallet any value at all?
Okay, so let's dig into that. How does this simple piece of paper get all its power? And how does that one idea blossom into the entire financial system that we all rely on today? Well, it all boils down to one thing: trust. Trust that's backed up by the law. Modern money is valuable simply because a government says it is. In India, for instance, the Reserve Bank of India is the only one that can issue currency, and the law says that it has to be accepted as payment. You can't legally say no to it in a transaction.
But here's a wild thought. Most of the money in the world isn't even physical cash, not even close. It's just numbers sitting in a bank account. We call these demand deposits, simply because we have the right to withdraw that money on demand, whenever we need it.
And this is exactly where banks become so critical. They're the ones who let us move all this digital money around. A tool like a check, which might seem a little old-fashioned now, is a perfect example. It's just a piece of paper with instructions for the bank to move funds from one account to another. No actual cash ever has to move.
And this whole process is really the engine of the entire banking system. It's pretty clever, actually. You and I deposit our extra money into the bank. The bank holds on to a small bit of that, say 15%, just in case we need it. Then it loans out the rest to people and businesses who need to borrow it. And that's how they make their money. On the spread, that little difference between the interest they pay you and the higher interest they charge the borrowers.
Now, this whole system of lending creates something we call credit. And credit is this incredibly powerful force. It can be a massive opportunity, a real game changer, but it can also be a devastating trap.
To really see what I mean, let's look at two totally different stories. They perfectly show these two faces of credit, one where it helps someone build a better life, and another where it pushes someone into a hole they can't climb out of.
First up, meet Salim. He's a shoe manufacturer, and he lands a huge order. To get it done, he needs to buy more leather and hire some extra workers, so he takes out a loan. Because of that loan, he's able to finish the order on time, he makes a really nice profit, and he easily pays back what he borrowed. For Salim, credit was the tool that let him grow his business.
But then you have Swapna's story, and it's a world apart. She's a small farmer who takes out a loan for seeds and fertilizer. But then, disaster strikes. Pests wipe out her entire crop. She can't repay the loan, and the debt just spirals out of control. Eventually, she's forced to sell a piece of her own land just to clear it. For her, that same tool, credit, became a trap.
So what gives? What's the real difference between Salim and Swapna? Well, it often comes down to risk for sure, but maybe more importantly, it's about the terms of the credit, what kind of loan you can get your hands on in the first place. This is a really critical issue.
To really get to the bottom of that, we have to look at where credit actually comes from. We need to see how the system itself can create a huge gap between the haves and the have-nots, and what we can do to close it.
So broadly speaking, credit comes from two different worlds. First, you've got the formal sector. These are your banks and cooperatives. They're supervised by a central authority, like the RBI in India, and they generally have lower, fair interest rates. Then you have the informal sector. This is everybody else: moneylenders, traders, even friends and family. It's completely unregulated, and the interest rates can be absolutely sky-high.
But here's the reality on the ground, at least in rural India. Now, while formal banks are the biggest single piece of the pie, what's really striking here is that a huge chunk, over a quarter of all credit, still comes from those informal moneylenders. These are the very kinds of lenders that trap Swapna.
And this divide gets even more dramatic when you break it down by who is actually doing the borrowing. The poorest households are overwhelmingly forced to rely on these expensive, high-risk informal loans. Meanwhile, wealthier households, they have easy access to cheap, safe, formal credit from banks.
So here's the fundamental problem we're looking at. If cheap, reliable credit is the ladder that lets people like Salim grow and prosper, but only the people who are already well off can get to that ladder, then the system itself is holding people back. This credit gap isn't just an inequality, it's a massive barrier that can keep people trapped in poverty.
But, and this is the really hopeful part, that is not where this story ends. All around the world, amazing grassroots solutions are popping up to tackle this exact problem. Things like these self-help groups, or SHGs, that you see here.
The idea is so simple, but it is absolutely revolutionary. A small group of people, often women, get together and pool their savings, even if it's just a tiny amount each week. This collective pot of money is then used to give small, low-interest loans to the members themselves. After they build up a track record of saving and repayment, the whole group becomes eligible for a much larger loan from a formal bank. And that right there, that overcomes the single biggest hurdle for the poor: not having any collateral.
And all of this brings us to this really powerful thought from Professor Muhammad Yunus, the Nobel Prize winner who pioneered this kind of microcredit. He basically argued that the system wasn't broken, it was just built for the wrong people. And it leaves us with a huge question, doesn't it? What if the key to unlocking global development isn't some brand new complex invention, but simply making the tools we already have fair and accessible for everyone?